China's interest rate cut did nothing to help support Chinese stocks, but will it help the Chinese economy? I'm joined by Randolph, Director of Sovereign Risk at IHS. This is the second time in as many months that China's central bank cut rates. Why now? What's behind the move we just saw?
I think it's to support the real economy. It's not really anything to do with the stock market. The real economy has been slowing. We think it'll slow to 6.2% in the second half from 7% in the first half. And exports in particular have nosedived. So it's been part of a series of support measures since November, cutting interest rates, cutting the reserve requirements of banks to support the real economy and growth. But that's all really because they have to do some really heavy lifting on the big issues, bad debt, re-engineer the economy, move it away from investment and real estate and more onto consumption.
So where is China in this progress from short-term support to tackling some of the tougher, more difficult, longer-term reforms?
Yeah, it's having to do both. It's having to rebalance its economy. It wants to move away from investment being 50% of GDP, the biggest driver, and that can be broken down into real estate as well as factories. But there's excess capacity, ghost cities, and they have to make all this bad debt related to it accountable. That's a huge structural reform project, usually on average takes 3 or 4 years. Meantime, growth suffers, but they don't want it to suffer too much. And that's why they've also, in parallel, used monetary accommodation, the cutting of interest rates to 4.6%, which is very, very high when we look at the West. And so they've got a lot of way to go still to support the economy while they're doing this more important heavy lifting on the structure of the economy.
Does that mean we might still see further rate cuts or further currency devaluation?
Yes, I think so. I think the move on the currency peg was really quite important and significant and had important implications for other emerging markets and their exchange rates. This is a move away from controlling the currency directly. It's a crawling peg. The crawl is letting market forces determine where it's going, and at the moment it's going down because we have capital flying out of China. But the peg is also where the state still intervenes. It's a halfway house towards a free float. But they can arguably say it's more market determined than in the past. And if we have a decline like this, a declining yuan, it's very insignificant because it means that they're exporting a bit of deflation around the world, whereas previously they were a big sink for deflation.
How worried are you about contagion from China, and what countries might be impacted?
Well, we've seen the impact already. We've forgotten how much we've relied on Chinese growth over the last 6-7 years with our own problems from the financial crisis. Emerging market demand contributed 2/3 of all new demand, new growth over the last decade. And China takes the lion's share of that, but that share is falling now. And the implications we've seen directly in terms of weaker exports to China. Many countries in Asia are impacted, but also Latin America. And then we've also seen the effect on commodity prices. China has taken the wind out the sails of oil, but a whole range of other commodities. And that's been a double whammy for a lot of emerging markets. And now they may also be faced with a hike in interest rates in the US Fed.
At this point, you still see growth for China for how long? I know you're concerned about your forecast for 2016. You think that growth might actually be lowered, but we're still talking about an economy that's growing.
Yes. While you're trying to re-engineer an economy and deal with bad debt, make it more accountable, what suffers is growth, and we've seen that. And moving on to a more consumption-based economy, that also means less growth. All this is somewhat inevitable. But it's still quite high. The problem is we're seeing a weakening in growth, 7% in the first half, 6.2% in the second half of this year, but we don't think the trough's there yet. We think the trough may yet come next year. And also, the figures themselves are somewhat questionable. The real situation could be a lot worse than what we actually see with these headline numbers.
Randolph, good to talk to you again. Thank you so much.
Thank you.
I'm Rhonda Schaffler for TheStreet.